Are you preparing for the NMLS SAFE mortgage loan exam and looking for an effective way to master key concepts? In this video, we'll dive into the top 200 NMLS mortgage loan exam flashcards to help you confidently tackle the test. From federal mortgage laws to ethical practices, these flashcards cover everything you need to know. Let's get started.
Ability to repay rule. In simple terms, it is a rule making sure lenders check that you can afford your loan before giving it to you. As per textbook definition, ability to repay rule is a regulation requiring lenders to make a reasonable, good faith determination that a borrower can repay the loan before approving it.
Absorption rate. In simple terms, it is how quickly homes are selling in an area. As per textbook definition, absorption rate is the rate at which available homes are sold in a specific market during a given time period.
Acceleration clause. In simple terms, it is a clause that lets the lender ask for the full loan amount if you miss payments. As per textbook definition, acceleration clause is a provision in a mortgage that allows the lender to demand full payment if the borrower misses payments or violates other terms.
Ad valorem. In simple terms, it is a tax you pay based on how much your property is worth. As per textbook definition, ad valorem is a tax based on the assessed value of real estate or personal property.
Adjustable rate. In simple terms, it is an interest rate that can go up or down over time. As per textbook definition, adjustable rate is an interest rate that can change periodically based on market conditions.
Adjustable rate mortgage ARM. In simple terms, it is a home loan where the interest rate can go up or down over time after starting at a fixed rate for a few years. As per textbook definition, adjustable rate mortgage ARM is a mortgage with an interest rate that can change periodically based on market conditions after an initial fixed period.
Adjustable rate mortgages ARMs. In simple terms, it is home loans where the interest rate can go up or down over time. As per textbook definition, adjustable rate mortgages ARMs is mortgages with interest rates that can change periodically based on changes in a specified index.
Adverse action notice. In simple terms, it is a letter explaining why your loan was denied or why you got less favorable terms. As per textbook definition, adverse action notice is a notice required by law when a lender denies a loan application or takes other negative action based on a consumer's credit report.
Amortization. In simple terms, it is how your loan is paid off over time, with each payment covering both interest and a bit of the original amount borrowed. As per textbook definition, amortization is the process of paying off a debt, typically a mortgage, through regular payments over time, where each payment is allocated between principal and interest.
Amortization schedule. In simple terms, it is a chart that breaks down how your payments are divided between interest and loan repayment. As per textbook definition, amortization schedule is a table showing how much of each payment goes toward interest and principal over the life of the loan.
Annual percentage rate APR. In simple terms, it is the total yearly cost of your mortgage as a percentage. As per textbook definition, annual percentage rate APR is the yearly cost of a mortgage, including interest and other charges expressed as a percentage.
Annual percentage yield, APY. In simple terms, it is the total interest earned on savings over a year, including interest on interest. As per textbook definition, annual percentage yield, APY, is the rate of return on an investment, including compound interest.
Appraisal. In simple terms, it is an expert's estimate of how much your house is worth in today's market. As per textbook definition, appraisal is an unbiased professional assessment of a property's market value conducted by a licensed appraiser, typically required during the home buying process or refinancing.
Appraisal report. In simple terms, it is a report that tells you how much your home is worth based on an expert's assessment. As per textbook definition, appraisal report is a detailed document prepared by an appraiser that estimates the value of a property.
APR, in simple terms, it is the total yearly cost of your loan, including interest and fees, shown as a percentage. As per textbook definition, APR is annual percentage rate is the yearly cost of a loan expressed as a percentage, including the interest rate plus other charges or fees involved in obtaining the loan.
ARM, in simple terms, it is a mortgage where the interest rate can go up or down over time after starting at a fixed rate for a few years. As per textbook definition, ARM is an adjustable rate mortgage, has an interest rate that changes periodically based on market conditions after an initial fixed period.
Assessed value, in simple terms, it is the value your local government uses to calculate your property taxes. As per textbook definition, assessed value is the dollar value assigned to a property for property tax purposes.
Assumable mortgage. In simple terms, it is a mortgage that can be taken over by a new buyer when you sell your home. As per textbook definition, assumable mortgage is a type of financing arrangement in which the outstanding mortgage and its terms can be transferred from the current owner to a buyer.
Assumption fee, in simple terms, it is a cost you pay when you take over someone else's mortgage. As per textbook definition, assumption fee is a fee charged when a borrower takes over an existing mortgage from another borrower.
Automated underwriting system. In simple terms, it is a computer program that quickly decides if you qualify for a loan. As per textbook definition, automated underwriting system is a computer system that quickly assesses loan applications based on the lender's criteria and guidelines from Fannie Mae and Freddie Mac.
Balloon payment. In simple terms, it is a big payment due at the end of your loan term after making smaller payments for a while. As per textbook definition, balloon payment is a large, lump sum payment scheduled at the end of a series of smaller periodic payments, typically used in certain types of mortgage loans.
Bankruptcy. In simple terms, it is a way to legally manage or eliminate debts when you can't pay them. As per textbook definition, bankruptcy is a legal process that allows individuals or businesses to reorganize or eliminate debts.
Basis points. In simple terms, it is a way to measure small changes in interest rates. As per textbook definition, basis points is a unit equal to 1/100 of a percentage point, used to express differences in interest rates.
Bridge loan. In simple terms, it is a temporary loan to help you buy a new house before selling your current one. As per textbook definition, bridge loan is a short-term loan used to bridge the gap between the purchase of a new home and the sale of an existing one.
Brokerage fee. In simple terms, it is a fee you pay to a broker for helping with a transaction. As per textbook definition, brokerage fee is a charge paid to a broker for their services, often a percentage of the transaction amount.
Buydown. In simple terms, it is paying extra upfront to lower your interest rate. As per textbook definition, buydown is a payment made to reduce the interest rate on a loan.
Capacity. In simple terms, it is your ability to pay back the loan based on your income and debts. As per textbook definition, capacity is one of the 4 C's of credit, referring to a borrower's ability to make loan payments.
Cash flow. In simple terms, it is the money coming in and going out of your business or household. As per textbook definition, cash flow is the amount of money moving in and out of a business or household.
Cash out refinance. In simple terms, it is a way to borrow money using your home's value while refinancing your mortgage. As per textbook definition, cash out refinance is refinancing a mortgage for more than you owe and taking the difference as cash, using home equity as collateral.
Closing costs. In simple terms, it is the extra costs you pay when finalizing your home purchase, beyond just the price of the house. As per textbook definition, closing costs is the fees and expenses paid by the borrower and seller when a real estate transaction is finalized, including lender fees, title insurance, appraisals, and various other charges.
Closing disclosure. In simple terms, it is the final list of all costs and details about your home loan given before closing. As per textbook definition, closing disclosure is a final document that outlines all costs and terms of a mortgage loan, provided 3 days before closing under TRID rules.
Collateral. In simple terms, it is something valuable you use to guarantee repayment of a loan. As per textbook definition, collateral is assets used to secure a loan, such as a house for a mortgage.
Comparables. In simple terms, it is similar homes used to figure out how much a house is worth. As per textbook definition, comparables is similar properties used to determine the value of a subject property.
Conforming loan. In simple terms, it is a home loan that follows standard rules set by big government-backed agencies. As per textbook definition, conforming loan is a mortgage that meets the dollar limits and underwriting guidelines set by Fannie Mae and Freddie Mac.
Construction loan. In simple terms, it is a loan to build a new home or project, usually paid back when the project is finished. As per textbook definition, construction loan is a short-term loan used to finance the construction of a new home or project.
Consumer Financial Protection Bureau, CFPB. In simple terms, it is an agency that protects consumers from unfair financial practices. As per textbook definition, Consumer Financial Protection Bureau, CFPB, is a U.S. government agency responsible for consumer protection in the financial sector.
Contingency. In simple terms, it is a requirement that must be fulfilled before a deal is final. As per textbook definition, contingency is a condition that must be met before a contract becomes binding.
Conventional loan. In simple terms, it is a common type of home loan that isn't backed by the government but needs good credit and a decent down payment. As per textbook definition, conventional loan is a mortgage not insured or guaranteed by a government agency, typically requiring higher credit scores and down payments than government-backed loans.
Correspondent lender. In simple terms, it is a smaller lender that makes loans and then sells them to bigger companies. As per textbook definition, correspondent lender is a lender that originates and funds loans in its own name, then sells them to larger lenders or investors.
Credit bureau. In simple terms, it is a company that keeps track of your credit history. As per textbook definition, credit bureau is an agency that collects and maintains information about individuals' credit history.
Credit enhancement. In simple terms, it is ways to make a borrower or investment look more reliable to lenders. As per textbook definition, credit enhancement is techniques used to improve the creditworthiness of a borrower or investment.
Credit report. In simple terms, it is a document showing your past borrowing and repayment history. As per textbook definition, Credit report is a detailed report of an individual's credit history.
Credit score, in simple terms, it is a number that shows how well you manage debt and credit. As per textbook definition, credit score is a numerical score that represents an individual's creditworthiness.
Debt consolidation. In simple terms, it is combining all your debts into one loan to simplify payments. As per textbook definition, debt consolidation is the process of combining multiple debts into a single loan, often with a lower interest rate.
Debt service, in simple terms, it is the total amount you need to pay each month to cover all your debts. As per textbook definition, debt service is the amount of money required to cover the repayment of debts, including interest and principal.
Debt-to-income (DTI) ratio. In simple terms, it is how much of your monthly income goes to paying debts. As per textbook definition, debt-to-income (DTI) ratio is the percentage of monthly income that goes toward paying debts.
Deed, in simple terms, it is the paper that shows you legally own a property. As per textbook definition, deed is a legal document that transfers ownership of real property from one party to another.
Deed of trust. In simple terms, it is a document that gives temporary ownership of your property to a third party until you pay off your loan fully. As per textbook definition, deed of trust is a legal document that secures a real estate transaction by transferring property title to a trustee until the borrower repays their loan in full.
Default, in simple terms, it is not paying back a loan as agreed, leading to potential penalties. As per textbook definition, default is failure to meet the terms of a loan or contract, such as missing payments.
Delinquency. In simple terms, it is being late with payments but not yet in default. As per textbook definition, delinquency is a situation where a borrower is late with payments but has not yet defaulted.